Yo, yo, what's up, amigos? I hope you guys are well. I hope life is good. If it's not, it's okay. There's shitty times in life. Things will get better. Um, Basically, in this video, I just listened to some song, by the way, Make a Lot of Money by Snoop Dogg. Sick song, really got me hyped up to kind of make the video, but also, get in the zone. So in this video, what I want to talk about is for anybody that was an OG follower. There was a play that I used to play with my friends, and I hope they're okay with me sharing this. I think they should be. But it's basically under. We used to long names, and we would get 500, 600, 700%, uh, and which is a lot. Um, Basically, reverse engineering dilution and small cap. It's a really really cool concept. It's very powerful. It's something I am very grateful that I learned. Um, Back in the day, people would play the short side, but there's different elements and kind of the thinking levels to it. But you could basically make it so that you can play swing long and make a lot of money, uh, a lot of money percent wise, and then it faded away for like a year or so where small cap was not working. So now that it's coming back, it may pick up. So that's the video in summary basically is going to be about going over THMO. This is not investment advice, and please don't take as investment advice. And also, I don't mean to be rude, but don't be dumb enough to put a lot of money in this or any money in this at all. If anything, the intention of this video is to help educate on how to find these plays, why do they work, but don't put money in it. Do I have money in it? Yes. Am I like I'm risking off $0, so it's like super duper small. But it's something that THMO, if I think if it works, uh, I perceive it potentially going to $1.20, $1.40, which is you know close to 10x, whatever you want to say. Not 10x, but close to it. So we're gonna go over what it is. That's what the video is gonna be about. Stay tuned till the end. So starting from scratch, this is not gonna be a basic tutorial understanding of filings. It's just gonna go over the bigger layer pictures and understanding. So there is there's various levels and elements to filings and understanding it. So one aspect you understand dilution exists. Another aspect is seeing through volume and through chart whether that happened. And another aspect and a variable is the business model. So if trading is not black and white, you got to put a lot of components together. So one aspect is the filing dilution, another aspect is the business model, and another aspect is it does it make sense with what happened in the chart? A quick summary overlay is basically companies that get low in cash often get pumped, and these guys they short ahead of the offering, which is illegal, but they do it, especially because they know that offering is coming. Like they participate in it and they cover, and SEC charges them a couple hundred thousand, whatever it is, and but they end up making like 10, 20, 30, $40 million. So it's like 100K, okay, cost of business. I'm pretty sure SEC knows about this, but it's somewhat sad. Yeah, I would say it's a sad truth of reality, but let's not get into that. So that's the bigger picture overlay of it. I'm not gonna go over what baby shelf rule and things are. I don't think so. So this one is it. So we're getting right into it. It's been 5 minutes. That sucks. Uh, okay, so THMO. THMO is a 31 million uh, OS. The float is 30 mil. They can raise about 1.3 mil through Baby Shelf and S3. You guys can look it up if you don't understand what that is. Just Google Baby Shelf and S3 is how they work. And that's with the close. So if they get a higher close, they could get a bigger offering amount. I think roughly they can get roughly 9 million. From the shelf because everything else is used up. Okay, and now the cool concept of putting it together. So what happened here, so this here was 61 mil. This here was 7 mil. Okay, so this is the summary of it. This company is low in cash. So regardless of how good the company is, if they're low in cash, they'll go bankrupt if they don't do some sort of a raise of financing. The odds that they use it an S1 is low because the odds that they use an S3 is low because right now they can only do 1 mil. So why is that? Why would they do that? Because the burn rate is massively more. It's about $4 million a quarter. So usually when they do an offering, you want to make sure that they try to make sure that they give them at least 6 months, 10 months, or longer. So the S1, on the other hand, which does not have, and this is the reason I'm actually making the video, because this is a bit more complicated. If it was a very basic looking forward thing, I wouldn't make a video on it. So the S1 is 10 mil, and it doesn't need to obey by the baby shelf. So in theory, because HC Wainwright is involved, and these are the underwriters, they could do an offering of that 10 mil, and they would be okay with it. So then it comes down to, so this could happen on Monday. Scenario one is they do a $10 million offering, which is what they could offer through S1. It's in the progress. Or the other thesis is that they could push into new highs, get a new close, and then from that they will. So the highest close in here we could see, I think, is, it might be this one. Let's see, the close is 42. So it's the past 60-day close. So it's somewhere here. So yeah, you guys can read up on the rule. The rule is like a past 60-day close. It's about 40 cents. So they need a higher close above that. So the question comes, do they do an S1? Well, like, what's the probability of this happening? Because nobody really knows. If I knew that this was going to go up massively, I would be a rich billionaire, right? Well, not a billionaire, but pretty well off, because I would just buy a lot on intraday, or short a lot intraday. So we're going with the probabilities. What is the probability of this doing an S1? What's the probability that it gets a bigger close above 40? And from that aspect, they will get a higher close and they can do a bigger offering through S1. So they also have a small amount of ATM. So the variables that comes down to play is, at the current moment, the S1 has $10 million worth. So once they use the S1, it basically gets depleted. You can't use it again. Now the question becomes, did they do enough? Was there enough volume for them to hedge? So this is under the assumption that there's some crooked stuff going on, which is shorting ahead of the offering. So whoever the underwriters that fill it, they're like, hey, yeah, we'll give you, company here's $10 million at this price, blah blah blah. So they short ahead of it. So this is what could happen on Monday. but I think it's going to be much lower odds. Why do I think it's going to be lower odds? Because if you can see here, there's actually 31. So you see it on here. There's 31 million shares traded. So when we do 31 million shares and we multiply it by, let's say, the average of like 0.27, 27 cents. So we see it only traded $8 million dollar value worth. From this, let's say they're being aggressive that they were 20% of the volume, because you have to like recycle and do a bunch of stuff and blah blah blah. So if they were short, they were probably short maybe on a best case scenario. You could some people use 10%, but I'm giving them best case scenario 20% of the volume. So they potentially could have shorted 2 million worth of thing. So when they short 2 million worth and they're giving 10 million, um, basically that's them covering their short position. So okay, I'm going to take a step back. They would, in theory, they would short $10 million worth of the stock, and when the offering comes, these guys would participate in the 10 million because nobody else really would give this company money, or companies like this money. It's a common practice. But the shorts and these guys that are repetitive customers will uh, they will come and they will be like, okay, we're going to give you $10 million worth because they have a short position. And when they participate in that offering for $10 million, let's say the offering comes and they're like, okay, we'll give you 10 cents. So they've basically literally locked in. If they were short from 30 cents and then they gave them 15 cents, so they locked in five. They locked in 15 cents per share. If their average was 30 cents, and then they're like, we'll participate in 15 cents. They locked in essentially 5 million if they shorted 10 million worth. So in this situation here, the odds that an S1 offering will come on Monday is very slim, in my opinion, because if they were 20% of the total dollar value short, which is a higher end, it'd be 1.6 million. So then there's a chance they could bag hold. Or the other scenario, the best case scenario is the when I don't want to say when, I guess there would be beginner fundamental short sellers that are doing the filings, or that are, they will be short. And then there's also technical traders that are going to be short. So they're going to be like, oh, look at this daily chart. Look at this candle. This candle went from like 50 cents, closed at 28 cents, make 50%. Oh, the other day gapped up, it went 50%. There's all these statistical traders and stat traders and all that jazz. So they're going to be shorting it. So what comes out from this is the next day, the next time that this runs up. I don't know when it's going to be, um, if it happens. So scenario one is that they do a 10 mil offering, and I'm wrong. Uh, I don't know at what price. Then maybe they're just bag holding until the under whoever fulfills through the underwriters is just going to bag hold it to the next pump, and they'll get rid of it. Or the other scenario is that the next time it pushes up, I don't know when it's going to be. Um, then the shorts will likely get, and the stat traders will likely short this, and they'll be like, well, it has faded. It's gonna fade. It has faded 90% of the times. I'm gonna take that stop. But that's the point where that's when it's gonna make the best long ever, because you have fundamental short sellers that are involved on the other side. So the other scenario is that it gaps up. Uh, let me see some things. One second. Uh, so in a few days from now, it gaps up and it pushes. Um, so for So the other scenario is that it gaps up, maybe potentially holds above 50 cents or something like that, um, and then it goes. How far will it go? In theory, above 250 is where the baby shelf. They're above that, but I don't think that's possible. It's not. There's lower chance of that happening, but it's there. But if you look at it from that perspective, it's like you get 10 to 1 risk reward from 20 cents. You're making 10 times your money. Um, and yeah, so if it gets a higher close, even if it doesn't get there, even if it gets like a 150, 160 close, then what will happen is you can just do the math. I don't want to do the math because I've done this a lot in the past. But you could just run through the numbers and be like, okay, if the close was 90 cents, uh, right now they can only do 1 mil through the S3, which is a baby shelf requirement. And then you look at the math. Okay, at 150 they can do this much uh, uh, through the S3. And then the key thing variable to keep in mind is that when an offering happens, and from my experience, usually they need to have a minimum of at least 6 months to 10 months or a year of an offering. So they don't want to leave them hanging. They build relationship with these third companies, and that's why you see gap and crap. Um, to rephrase that, if it was confusing, is they so if an offering happens, they're not going to do an offering just to kick the can 2 months, 3 months down the road. So if these guys had 1 month of less than 1 month of cash left, they won't do an offering. So if their burn rate is $1 million, they're not going to do an offering for $1 million or $2 million. And the reason for that is just because it's 2 months. They will try to give them 10 million or 12 million, which is perfect. So right now, I think their burn rate is about like 1.25 mil, something like that. So this gives you an idea of like, okay, where does the close have to be for them to get like, you can that's how you can actually find price target portion. So if they're, geez, I don't want to do it, but let's do some math, I guess. So let's say if their burn rate was 1.25 million, at 1.25 mil, um, how much cash do they need to get 12.5 mil? So for 10 months, let's say the offering is going to be for 12 months. So then you do look at the math. You're like, okay, so there's an ATM also, which is like, I think 2-3 mil left. So you subtract it from that. Um, so I think, let's say if the ATM was 2 million left, 10. Um, from here, you would do the math. So at this current price of 40 cents, they can raise 1 million. So if it's at 2 million, if it if it's just at 1 million at 80 cents, if my math is not wrong, it would be 2 million, etc., etc., things of that nature. So you gauge an idea of where the price needs to be, and also in the past, uh, if they had done an offering, they usually get warrants, so they try to push it a bit above that. Um, and the other really weird concept is a lot of people think that they push in into the warrant prices and get and exercise it. An example is I've heard some people say that the warrants are at $3. So in this case, we'll keep it simple. Let's say if the warrants were at 60 cents. When it touches 60 cents, people are like, and it fades, and they're like, oh my God, it's the warrants. They exercised the warrants. I swear they did, blah, blah, blah. That's not the case, because when you exercise the warrants, you actually have to give the company the money. So you're not really making money. So basically, the warrant at 60 cents is a reference so that you can pay 60 cents and get a share, or get one share of that warrant. Um, so you wouldn't exercise it down here. You could do something which is called black-scholes delta hedge. So if you had 50 million warrants, um, getting an extreme example, gets us 60 cents. You could just short a little, and especially if it was a beat down stock, and this way that you're kind of locking profits in. So if it goes higher. So amigos, good news and bad news. I was rambling on for another 6 minutes or so, but I just rewatched the video. It got cut out. Last thing I was mentioned was the 60 cents. I rewatched it so that I could continue the thought flow. Um, the concept for the Black-Scholes model is just it's an important uh, thing to understand that warrants. If you are a warrant holder, it's only logical to exercise it when it's a bit above. Um, but it gets nothing is black and white. But if the company needs cash and it goes a bit above, and these guys are doing shady things, like maybe if it goes to 67, 65, you could exercise some of those warrants so the company gets the cash, whatever metric ways to help them. But more often than not, in this example, where if the warrants were at 60 cents, ideally, if it gets to 75 cents, a dollar, that's when a logical perspective is that you will exercise the warrants because you're instantly making money. You buy something instantly at 60 cents and you're selling it at uh, like 80 cents, a dollar, whatever it is. And the Black-Scholes models of shorting at 60 cents is basically just like time value of money, especially if the stock is crappy. And then, if it goes higher, then it's like, okay, well, you can just short higher a bit, knowing that you're not going to have infinite loss, but you're actually locking in profit. So the idea behind this was, I apologize if I mentioned it before, I'm just remaking this video again, is to finding the target price. Like, well, is this going to go just 40 cents, 50 cents? If you buy it at 25 cents, if it goes to 50, that's like 100% gain. But how do you find profit targets? So if I see overhead at 60 cents and I know that it's really big, like the example I mentioned, if it was 60 million shares, just these are not real, that's not a real situation, but I'm giving an example, I'm making up an example. Then I would anticipate that, well, likely it's going to go to 85 cents or 90 cents. So that's how I pick my profit targets. Another aspect is that I was explaining, I apologize if I'm re-mentioning it, is going and seeing at what price, how much they can do an offering. And would this give them like 10 months, 12 months of cash? So if they get a close of 90 cents, so that means obviously it's going to push to like 111. But at 90 cents, if they're going to, let's say if our thesis develops that they're going to they need a higher close. If it at 90 cents, if this company is burning $1.25 million a month, at if they get a 90-cent close, then they can only raise 2 million. Therefore, I personally would not really sell there. Again, there's a big difference. Do not follow this just because I'm saying this, but there's an S1 which doesn't obey the baby shelf rule. But if we're talking just from an S3 point of view, if I'm doing the math and then I determine that at 90-cent close they can only lose 2 months, 3 months, then they're going to push it higher into a bigger close or trap more shorts and some of that nature. So that's how I identify the profit targets. The idea of this video is to help and kind of to help anybody that's putting in the work to understand the filings. It can hopefully help you make money, because this filing stuff is not easy to understand, and I would recommend the dilution tracker website. But outside of that, even before that, I think you have to do the work yourself and understand these things and know that there's various elements to it. So there's understanding the dilution, understanding the business, and then looking at the price action and formulating your thesis. Uh, if you've made it this far, I appreciate you, given how many times I've said and given how lengthy the video is. But I hope it's helpful. And if you made it, if you came this far, then I hope that it was because it was useful and beneficial. So share it with somebody else that you think will benefit from this, because it would make me happy. It's not. It's stock trading is a very tough game, and when we can help each other out, push a little harder, it's awesome. If it puts some lights on in our head, I know it helped me a lot. So I just want to pay it forward, and I hope it helps. And if it doesn't help, don't sue me. don't take this as investment advice. 100% I'm being serious. Like don't put your money. I'm risking off if it goes off the $0. I don't have super high conviction. And that's all. Click subscribe because if you got this far, you enjoyed it. Share it with somebody, and then also so some of you guys may know or may not know, I have a small little prop firm, and I'm always going to keep it small. There's about 5-6 of us, and I'm going to expand it to maybe like 8-9 people. So if you are a 6-figure or 7-figure trader outside of USA, you want to be in a group of people where the way it's set up is it's supposed to be financially beneficial compared to retail brokers. So your commission is 0.0006. So you get like a 90% discount compared to retail. And then you have market maker routes, and then you also have, from a locate perspective, you only pay what you use. And we're using DAS, so you guys are welcome to do that. And if you want to help contribute to my aspect, I love if somebody's putting in work and that you're finding, based on what I explained, and if things clicked in and you're like, well, this is a company I found, they're low in cash, these are the underwriters, and this is why I think it would go up. Shoot me a message. Twitter, for either whether you want to join the prop firm or whether you have any companies that you want me to look at from a small cap cash flow point of view. You guys have a wonderful rest of the day. Share with somebody again if you thought it was beneficial. Subscribe, anything else you guys want. And let me know if you guys want, what kind of video you guys want. I'm happy to see what you guys want to listen to or what kind of videos. And I have some plans of getting some of the traders on voice, and then because we do monthly recaps and weekly, every few weeks recaps, so I think that may be beneficial as well. So have a wonderful rest of the day, amigos. See you.